And obviously, the opposite would be for institutional sponsorship. In short setups, we would be looking for, again, higher time frame price displacement, and that's going to come by way of a reversal or expansion or a return to fair value. And an intermediate term imbalance in price, that's seeing price move to a premium or moving towards the buy side liquidity, make a run on the buy stops. And then short-term sell liquidity below the marketplace. This is going to be ideal for pairing short exits to cover. And obviously, those sell stops, we're going to be buying those from the counterparties in the marketplace. We would be looking for time of day influence, i.e. London Open high of day or New York high formation. Okay, we're looking at a higher time frame chart. Okay, just for disclosure's sake, this is a Japanese yen, and we're looking at a daily chart. The criteria is for our setups to be high probability, we have to have institutional sponsorship. Now, what is institutional sponsorship specifically? It's the willingness to protect an underlying price swing that has high probability of unfolding. Institutional sponsorship is just the impact of large institutions, banks, and big equity traders coming in to fund the side of the marketplace that you anticipate seeing it run towards a particular side of the marketplace. For instance, if we're looking at a buy setup, we're going to be measuring and trying to identify characteristics that lead us to the assumption and ultimately an understanding of institutional sponsorship as a concept, so that way we can go forward in our trading and start looking for these fingerprints that are many times repeating over and over again when we use higher time frame setups. You see it shows price dropping down below an old low. And this is typically where sell stops are going to be residing, or as we call it, a liquidity pool below this old low, and everyone that would be wanting to go long, they would have a sell stop rate below that. And then the fact that because everyone's doing that same idea, putting a sell stop here, that's where the idea of a liquidity pool. All those orders are pooling together, okay, and creating a pocket, if you will, of selling interest. Now, it doesn't mean that they want to go sell short. Okay, some folks out there would see that as a particular interesting level to be short at a later time. Should we break below it? But in this case, when we see a price run like that, we obviously have to assume, again, it's that market efficiency paradigm again, participants are looking to protect long positions there. So it's not that they want to get short, they want to get out of the long position. Now, an aggressive trader, they can see this as an opportunity to go into a lower time frame as that low is violated here. Right on this candle here, you can go into a lower time frame and look for a similar pattern because price is fractal. So you can look into a lower time frame and actually study the price action and come to basically the same idea you're seeing here, an old low. So we would wait for short-term price action on a lower time frame to create that same scenario, which is a low being violated. By having that understanding and expectation, we can take a long position. We're going to go one step further, and we're going to actually start looking for evidence of institutional sponsorship. Now, looking at this setup, what's the first thing that comes to mind for you as a trader? Well, if we're anticipating a market move higher from down here after a run below the old lows, we start looking for, okay, where could this market go to? Well, we have a short-term high here. We have a short-term high here. Look at this big candle here. And how about this old high back here? Price could ultimately go back up here, or it could just come in this area here, close in that range, or it can come up and clear these relatively equal highs. But looking at what we see here, price is forming a potential bullish order block. Now, this old high here, obviously we know what's going to be resting above that. It's going to be buy stops. Well, we have a last down candle here. Price is now reaching into that right here. And it's also dipped one more time into that area right below this old low. So we can anticipate now some sensitivity and protection of seeing the price not go lower. That's what we're anticipating. So if we see that, we're going to see what? Characteristics of institutional sponsorship. That means the banks are coming in and they're capitalizing that old low back there. So inside this liquidity void and above this old high, what do we have up here? This is called buy side liquidity. That means there's a willing participant or pool of buyers up there. So as a market maker, they see these opportunities to sell, to run the stops that are below this old low. They're probably accumulating those sell stops in the form of taking the buy side of it. So if they're willing to buy those sell stops up, that means they're primarily building a net long book. And if we have suggestions in the marketplace in the form of price action suggesting that we have buy side liquidity in the form of a liquidity void and old equal highs back here, we may see, in fact, a very easy, low risk, high probability trade scenario to be long. Later on takes off and fills that void in. This is higher time frame price displacement. That means there is clear evidence that there is a large entity entering the marketplace. And the reason why we know that is because if this is a daily charts are not going to move that dynamic without sponsorship behind it by banks or large institutions or big equity traders. So when we see this, obviously we have to go back to where did that move begin? Everything has to have a origin. we go back to the beginning of that price swing. That higher time frame price displacement has to have a root price level at which we can classify as an institutional sponsorship level. That comes in the way of this order block right here. That last down candle, we're using the body of that candle here, not so much the wick, because the wick is basically the body of this candle as well. Price comes down and hits that level. Now, again, to identify institutional sponsorship in a particular segment of price action, you need to see immediate dynamic response. If it's lethargic, if it's not willing to move right away, that means there is no institutional orders in that area. So therefore, if you're in a trade and you see that lackluster activity, the first thing you should be thinking is either reduce risk, cut the position in half, or just completely bail on the trade. If you're on the right side of the marketplace, the market's going to move dynamically immediately as soon as you get in. If you are offside, you're going to see either the market hauling him back and forth, stalling, and then ultimately reversing on you. When we see this sell stop low capitalized by this buying in here, we see this higher time frame price displacement, and that's what we're seeing here. This is the evidence of a large body or entity that has a lot more money than us, and they got into the marketplace here. How do we know that? Because price surged, and again, this is the daily chart. So if price can get back down to that level again, price should see a responsiveness on the upside. So we're going to start looking for signs and evidences of institutional sponsorship there, because we already identify an area where price should see return to buying again, because it had a strong willingness to want to be bought up at this level here. So we're back down at that level again. So we should see upside momentum, or if not for anything else, a short-term bounce that we can actually trade and take some profits off of. So focusing on this bullish order block here, that's where the institutional sponsorship is going to begin. So we got 1 and number 2 of the criteria when we're looking for institutional sponsorship. We see higher time frame displacement, and we see price trading back down into a discount, basically returning to a fair value or back to an old area where it was bought up the last time. The next level is where's the short-term buy liquidity. That means the buyers that would be above where current price market is right here. Well, we have a short-term high here. We have a short-term high here, but we also have this old swing high back here, which was the midpoint of this overall price swing here. Okay, so we had a consolidation, accumulation, price explodes, okay, and it reverses up here, and it comes back down to the area at which it was bought up again. If we see a willingness to go up, we have to take our position off at logical areas. If the market can come back above this old high here, that's showing a willingness to do what? Hold for higher prices. So if they're going to hold it to this level here, where would be the next level? Well, above this old high, there's buy stop liquidity, and price obviously goes up there and hits it. Now, here's the thing. As price hits that level right up here, what's it doing? It's pairing orders with buy stops. So that buy stop liquidity is gone. So what's the next level of institutional order flow? That old high back here. If it's going to go up here, that means it's going to be highly unlikely for it to come all the way back down to this level again. Why would that be unlikely? Because we've seen this low here and it rallied higher. We've seen this lower low here that went below this old low and it rallied up. We came back down to that same level here and they bought it again. Now this time we were able to move above this old high. So market structure on the daily chart has now changed to bullishness. So if we see this, institutional sponsorship should protect price from ever coming back down into this area here. We've already cleared an area right here, this old high. If we were trying to buy here, and our ultimate objective would be to take our profits up here, if we grade that swing, this would be origin, this would be the midway point or equilibrium, and then terminus would be up here. So there, inside this little section of price action would be the first grade of that price swing. This is equilibrium or midway point. Then there's going to be something up here, probably, before we get to that level, and then ultimately up here, terminus. So we have 4 stages of that price swing to identify. And institutional sponsorship should support price at those logical areas in price. Down here, usually it's pretty quick. They don't want to get you an opportunity to get in there. Okay, and once it takes off, then you got to look at the equilibrium price point of the overall price leg you're trying to capture. In other words, we're trying to buy down here and get off our position up here. But in here, we do not expect to see price come all the way back down to this level because we've already seen it trade from this level here, this level here, this level here, and now we have market structure breaking on a very intermediate term basis with this old high being violated here. We have a down candle in here. Price has already moved to the midpoint of that candle right there. So institutional sponsorship should be identified in this area here. They should not see price come lower. And if we see that, then it's going to be a high probability the market's going to want to reach up for this level up in here, which is aiming for these old buy stops. So we're going to take a look at that whole thing in the form of a 4-hour chart. As price came down and hit that level here and gave us that same fractal idea, trading below an old low. And what's actually occurring here? Well, it's dropping price, but it's dropping at a specific level or going into a higher time frame support level. What's that create when it does that? It's a bullish order block. It's down price or down candles at an anticipated level of support, or where we expect to see institutional order flow send price higher. Each time the market goes up and takes out a level of buy stop liquidity, we don't collapse the trade entirely. We don't look for reversal patterns. We do not look for divergence indicators. We're looking for a willingness to keep moving higher to run these longer term buy stops. As price takes that first level out, those buy stops are gone. What's missing now? The liquidity in the form of buy stops above that short term high. So what we'd be expecting to see is price continuously look to go higher to go after the next level of buy stops. Price surges higher, runs through, takes out the second level buy stop liquidity. Now notice what's happened here. While it was a dynamic surge through that second level buy stop liquidity, it fails to go back to that old high. This is classic price action. So again, those buy stops are gone, and we're focusing primarily on a move justified by price action. Is it going to still go for those buy stops above that old high here? And ultimately, it runs up and snaps through that old high, ending that at the terminus. So let's take a closer look of why this was such an easy expectation and how institutional sponsorship could aid you in your price action study. When you see buy stop liquidity as your targets, what things should we see in price action to help support these ideas? Okay, we're looking at a 4-hour chart of that price swing. You probably already noticed there's some blue line segments on there. So we're going to start talking about some super secret sauce. We're looking at now a 60-minute chart. Those blue lines are one of the coolest things I discovered about price action. Okay, so again, you can see those gray lines here, and all that's doing is just delineating those old highs. Then we have the beginning of the move here. Price trades down. I want you to take a look at the blue line segments, the opening price at midnight in New York. If we suspect that price is going to be bullish, we can look at the opening price at midnight in New York. And if we're expecting a price move higher, what we see in the form of institutional sponsorship is price when it goes below the opening price at midnight should be accumulated. We want to see what happens when price goes below it. We find the opening price, and then we're going to be looking for a down candle. That down candle should be seeing capitalization of new longs. We see that come to fruition when the down candle is violated. Now, it can happen during London or it can happen in New York. Either one is still a good, viable trade. So between this high here and this low here, we're essentially trading at equilibrium. So when we're at equilibrium price points like that, we want to see price give us an order block to give us the justification for wanting to expand higher and away from that equilibrium. So now think in terms of Power 3. Power 3 is the concept I teach as it relates to the daily open, high, low, and close bar. So in other words, a time frame of daily charting. If your minimum trading is trying to capture the bulk of that daily range, you want to be buying near the opening on an up day and exiting on the close. When you're bullish, you want to be buying near or below the opening price, a low up to a higher close, a low up to a higher close, and again a low up to a higher close. But look what's happening. Price is being drawn up to that first old high. And look what it does. Once it gets up at that old high, it starts staying sideways. It's consolidating. Traditional support and resistance players will see that old high as resistance and they'll want to sell short. So what's going to happen? They're going to sell short, sell short, sell short, and they'll see what? Price go nowhere. And their buy stops will be just above this old high. And then you run through them again. They come back down, capitalize new longs, and then extends it up where? To the old high here. And what's happening there? Same scenario. So price in here, that's where we just left off at. Price comes back down into that order block here. It has a retracement and goes lower. And now this retracement lower will get everybody excited thinking it's been a high formed. Why is this one being used again? Because we had this old area of institutional order flow in the form of the old high. That's when classic support resistance works. Because why? We have an unfulfilled objective up here with that old higher high. I want you to think about where these order blocks are forming. You're referencing old bullish order blocks from the previous day or maybe 3 sessions ago. And you can buy old bullish order blocks because they're going to do what? Recapitalize them. That's institutional sponsorship. They're defending specific levels. Why should they be defending these particular levels? Because their vested interest is to see it go above that old higher high, where they're ultimately looking to try to take out all of their long positions. Everyone asks for what's the order block to use. Well, it starts with understanding where the market should go, okay? And that starts by looking at what we talked about in September, which you should be focusing on right now. Down candles right before the up moves, up candles right before the down moves, looking for liquidity voids, looking for old lows to be violated and then rallied off of. That's a turtle soup. Or an old high to be rallied through and then rejected and trade softer. That's a turtle soup sell. But you have to use specific generic things like time. Every order block that we refer to here is linked to a London session or a New York session, and they're happening from the previous day or a couple days ago. But the idea is they should be capitalized again because there is an underlying interest for the market maker to see price go higher. So they're not going to allow much in way of retracement. But if it retraces, it's going to go back to logical areas in the form of bullish order blocks or running an old low. Now the lows can be, again, the same way, an old previous New York session or London low. They'll take out the sell stops below the lows and then rally it up. The same thing can be seen with the bullish order blocks. You want to be focusing on the London session and the New York session and using these down candles in those previous sessions to give you new buying opportunities. If you're seeing that come to fruition in your charts, you are seeing and identifying institutional sponsorship. Every one of your successful trades will have this hallmark. Specific order blocks that take place at London and New York, they will help you discern whether there is institutional sponsorship in your particular trade. If you see the lack of that, chances are you're probably offside and you're either going to want to reduce the risk on the trade or maybe go to the sidelines and wait for another opportunity.